Nicholas, thank you for joining us. You've just posted, arguably, in fact inarguably, your best results since the financial crisis, with an ROE that's now sort of firmly in the teens in the second half, and all the businesses improved their profitability. We refer to the Macquarie model, is the new Macquarie model now complete, or does it remain a work in progress?
Well, I think the nature of Macquarie and the nature of the culture at Macquarie means that our people will always be looking for new opportunities. As you know, we historically have been a very much grassroots-led organisation where our people, we have very good people, and they're out there looking for opportunities on an ongoing basis. So all the different businesses we have, the 6 different business groups that you saw in that presentation, there are people within those groups looking at how they can be growing their business, what new opportunities they might be able to extend the current business to. So it is a dynamic organisation, and when we think it will continue to be.
But could you foresee further structural change in Macquarie, the sort of change we've seen since the crisis, or is the basic skeleton of the business now intact?
Well, I think we're maybe expressing that a different way. I think we're very happy with the businesses that we have. We're pleased to see how they're operating. As you say, they have increased. Each group has increased its contribution to the whole this year, and all of them have very interesting plans afoot. So I think we're very pleased with where the group sits at the moment.
Just picking out a couple of businesses, or one in particular, a significant source of your earnings is coming from the marshalling of bank deposits and then investing those deposits in things like home mortgages via Yellow Brick Road and other places. First of all, what do you think is the growth prospects of getting deposits in this market? And then I'll take you on to the growth prospects for taking market share from the banks.
Okay. Thanks, Robert. As you know, we entered the Australian mortgage securitisation market many years ago when we were looking at, we set up a vehicle called Puma that supported people like Aussie Home Loans developing in the broker network in the market. Now that business continued to grow well, and I think it was in excess of $20 billion in terms of receivables at the time of the financial crisis. Now at that stage, obviously the securitisations markets died globally, including in Australia, and so we stopped writing securitized mortgages at that time. So there's a hiatus for a period of time, and during that period obviously our book ran down, and as you say, with the development of deposits on our balance sheet that took place over that period, that allowed us to effectively re-enter the market and start writing new business again. So we went from about $20 billion of mortgages down to about $8 billion, I think, Patrick, in terms of the low level. And now we've stepped that $8 billion up. We're growing that, and we've brought that back to $17 billion. Formerly, as I said, it was being funded by securitisation. Now it's being funded by deposits. Giving you an idea about those deposits, we have in excess of $30 billion of deposits on the balance sheet, and they're what we're using to fund the growth of that Australian mortgage business.
Do you think you can, given that rates are lower now, do you think there's opportunity to grow that level of deposits, or do you think it's probably maximised?
Well, we saw growth of 7% over the last 12 months, so it shows that the team are effectively growing it. A lot of the deposits come out of the rest of the BFS business, and so as you grow the rest of the BFS business, whether it be in wealth or insurance and all the other areas they're operating in, then we see a flow on to deposits. And so there will be a rate of growth issue, but given it's coming out of the underlying business, that 7% we saw last year, if things go well, we should continue to see that growth going forward.
So you're at $17 billion now in terms of loans to mortgages.
Yep.
Do you think you can develop that into a significant rival to banks, or do you think you'll always be a niche player?
Well, I think the way Macquarie looks at these things is always one step at a time. Obviously we're about 1% of the market today. And we were, I think, probably in the pre-crisis days, we probably would have been approaching 2% of the market. So that's the range that we've been in to date.
Nicholas, the fixed interest currency and Commodities Group result was really impressive.
Yes, it was.
You've demonstrated, at least, that there's been a lot of speculation about your interest in acquisitions to expand that part of the business.
Yes.
Do you have a competitive advantage in those sort of segments?
Well, the competitive advantage comes out of the people we have, of course, Stephen, as you know only too well. We have got a good team of people there. We've been doing business in the broader fixed space, obviously, for many years, and Andrew's the head of that business, Andrew Down, very experienced. He's operated across, I think, virtually all elements of it, starting, I think, in foreign exchange and doing gold funding, gold bullion trading, and obviously playing a really important role in developing and driving the energy business. That's contributed so well for us in this last 12 months, and in fact did the previous 12 months as well. So the strength of our business is the strength of the people. I think they've demonstrated again this year that they are really a first-rate team. I think even something like the MEC business, that's lending to small mining companies and small oil and gas producers, that has been marred in the last 3 years by impairments on the equity side of the business. Notwithstanding that, they've demonstrated over many years, probably 30 years of operation, that they are very, very highly skilled, and they know a lot about small mining companies, small oil companies and gas companies. So again, we feel we've got a very good team in the energy space. We feel we've got a very good team in this MEC space. The people in our FIC business, which is fixed income and currency, have done very well as well, and the other commodities areas. So I think we only, at Macquarie, we try to be very rational about these things and look at the team and look at what they can produce in terms of judging them, and we think they've been able to produce not just this year but consistently over many years.
Are you a bull or a bear in terms of iron ore and coal and gas prices?
Well, we rely a lot on the Macquarie research that you've probably read, Robert, and I think they're probably more optimistic than pessimistic about the space. I think I'd have to check, but I think their medium-term forecast for iron ore is something about $100, and coal is in a similar sort of position. So it's not top of the market, but it certainly believe there will be strong demand coming out of the urbanisation of China for many years to come.
Sticking with that business, Nicholas, in the US, because of the Volcker rule, and then I suppose for different reasons in the UK and Europe, there's a lot of pressure on the commercial banks to get out of that sort of commodity trading, particularly physical commodity trading space. Does that create a regulatory arbitrage opportunity for a non-US, non-European bank?
No, not really. I mean, as we mentioned in the conference, Stephen, the competition is very real across all these markets, whether they're from regulated people or unregulated people. There's obviously lots of trading companies in the space. There's no shortage of competition, so there's no real advantage to us, I think. I think over that.
Does the competition come these days more from, or is likely to come from trading groups, commodity trading groups and hedge funds rather than traditional banks?
Well, I think it's been like that for a while. If you look at our gas business, for example, we're the fourth largest gas trader in the United States. I think 1, 2 and 3 are all industry players. So it is very much the industry players who have dominated and probably will continue to dominate in their various segments. The gas companies in the gas, and obviously coal companies in coal, and oil companies in oil, and so on and so forth. So we would expect the incumbents in those areas continue to be very, very important.
Nick, when you're a producer of a commodity and you trade, you have your production as your backup. But you're in the trading business. As CEO, do you get concerned about the risks your traders are taking?
Sure. We have to operate in this business, obviously you have to be very comfortable about the risk management framework you have around the business. And needless to say, we do have a very, very strong risk management framework for all the people who operate in the business. Everyone's got a very clear limit in terms of what they're allowed to do. If they breach the limit, it gets notified immediately. We have limits, all sorts of limits in terms of looking at what can happen in worst case situations. We have a very heavy compliance role that we play in this business, where there's regular monitoring, of course, of all transactions, all trading, all activities of that nature.
But if there was a sudden rise or fall of major nature in a particular area where you're trading, are you vulnerable to loss if you're on the other side of that?
Yeah, well, we look, the limits that we set, and that's a very good question, because that's exactly the way we approach it. We basically try to imagine bad things that can happen out there, and the traditional situation is that we have a major oil shock of some description, and we say, if this oil shock will happen, what will the impact be on our business? And we make sure that when we see that impact, we see the potential loss of that impact, we size all our exposures on the basis of that event occurring. So we are going through this scenario analysis on a constant basis. I can't remember how many scenarios we run overnight, but literally thousands of scenarios where we try to say what will happen in the event of these macro things, where will our book be placed, and we have to, of course, be very, very confident that we can not just survive it, but actually move through it well.
In rough terms, what percentage of your profit would come from trading?
Well, it depends what you call trading. I mean, what we do in commodities, we wouldn't, we're not taking principal positions in this business, so we're not out there saying we think oil's going to go up or down. What happens is we'll be working, in the gas business, for example, we'll be buying gas from people who produce oil, we'll be buying capacity from people in pipelines, we'll be buying storage capacity, and we'll be entering into contracts at the other end with industrial users and retail users. And our job is to take the oil from the wellhead, or the gas, I should say, from the wellhead, and deliver it to the wholesale/retail users. Now, that's what we're seeking to do. So every position we have we obviously, in terms of that value chain, we're trying to take, whether it's cents or whatever it is, out of that particular series of transactions that result in delivering the gas from point A to point B. We don't want to go out and be long gas or short gas at any particular time. Those things will arise just because the natural way of the world, not every piece of the puzzle will fit together, but it's not our objective to end up with those pieces. It's our objective to be able to move things from point A to point B and actually receive a fair margin for doing it.
I think we're going to have to wrap this up. Maybe one question, is that okay?
Okay. One of the surprising aspects of the result to me, Nicholas, and it probably shouldn't have been a surprise, was the extent to which you're now so much more an international business than an Australian business.
Yep.
And the extent to which the Americas are now your major profit centre.
Yes.
Is it inevitable that Australia continues to be a diminishing proportion of the business? And if it is, does that mean you've got to look at the way the business is structured and managed?
Well, it is a dynamic issue. The people internationally, our people in the US and in Asia and Europe all have aspirations for growth, of course, but so do our people in Australia. And importantly, we talked about Greg stepping up to take over BFS during the year. Greg has a lot of plans in terms of what he wants to see happening for banking and financial services in Australia. It includes things such as the mortgages that Robert's talking about. It includes insurance. It includes wrap. It includes wealth. It includes credit cards. It includes a whole range of retail financial and business banking, a whole range of retail financial and business financial products here in Australia. Now we are investing in terms of that those opportunities. We're investing in those opportunities in the expectation that it'll go well. Ultimately, of course, the shape of the group will be determined by how successful our respective teams are in the United States, in Europe, and Asia, and Australia. And in that regard, obviously, our teams have been successful in Australia over the years, and we sincerely expect them to continue to be successful going forward.
If you were successful, would you look to get 3 or 4% of the banking market?
We don't look at it like that. We look at it very much as a product by product basis, and as I said, unless we can see that we can actually bring something to the market and that there's real genuine profitability there, we're not doing it for the sake of winning market share or some other metric. It's very much a profit value focused approach.
Nicholas, thank you very much for your time. We appreciate it, how busy today is for you. So thanks again.
Not at all. Well, thank you, Stephen, and thanks, Robert.
Thank you.